Hey folks, Chris Versace here, Tematica Research, Monday, December 16th, the last full week of trading for 2024. Hard to believe, but yes, that is indeed the case. Now, as we get ready for this, again, final full week of trading for 2024, the S&P 500 is up just shy of 27% year to date, making it an extremely strong year, arguably far stronger than many thought back in January and February. Now, that's the good news. The kind of interesting news is that following the market action last week, when we look at the S&P 500, it is technically short-term overbought. That likely means that we're going to see some bargain hunters kind of picking over stocks that have fallen, some far more than the market did last week. But we also have, over the last several weeks, a record number of inflows coming into the stock market. The thinking here is that the combination between the market being short-term overbought and all these inflows, it's likely to fuel a Santa Claus rally as we get closer to the Christmas holiday. That's the good news. The potentially okay news, however, is that before we get to that, we do have to contend with the Fed's December policy meeting that concludes this Wednesday. Now, expectations are that the Fed will deliver yet another 25 basis point rate cut, and that will bring the total to about 100 basis points since September. The debate, however, and this is where things can get a little tricky, is that the Fed is likely to telegraph a slower pace of rate cuts than it previously expected for 2025. Remember, the Fed is, trying to figure out where is the neutral level of monetary policy. It has been restrictive. Fed Chair Powell and others have talked about this, but the question is how quickly will they find that neutral stance, and where is it? Because they're not necessarily sure, given some structural changes in the economy. Now, what could complicate this timing is that, as we've seen with data from October and November in particular, that inflation remains sticky, or arguably it's moving in the wrong way. And when we look at the consumer price index data for these months, the producer price index for these months, or even recent wage data, it all suggests that inflation pressures are, again, either sticky or potentially rekindling. That means that they're not really making a lot of progress towards the Fed's 2% target. Now, this week, when we get the policy statement, we also get two other things. We're going to get Fed Chair Powell's presser, which we usually get, but we're also going to get an updated set of economic projections from the Fed. Now, when we listen to Fed Chair Powell's comments, it's going to be his tone and his words that folks really focus on. Is he incrementally hawkish? Is he a little more sobering? Remember, when he appeared at the Deal Book Summit recently, he said that the economy has been stronger than the Fed expected back in September, and that inflation, yes, has been stickier, and that the Fed could afford to take its time with monetary policy. So I kind of see that as Powell laying the groundwork for the Fed to deliver a set of updated economic projections that kind of show a slower pace of rate cuts next year. Now, the good thing about this is that is what the market has come around to thinking. When we look at the CME FedWatch tool, yes, it does show that the Fed expects a rate cut, that the Fed is expected to deliver a rate cut this week. But when we look to 2025, it only has two more rate cuts penciled in, and that is a smaller number than the Fed shared in its September set of economic projections. So my thinking is that if the Fed delivers two or more rate cuts as it telegraphs its moves with the updated set of economic projections, the market is going to be fine with that. If, however, the Fed gives us very cautious comments about the pace of rate cuts, and the updated set of economic projections shows fewer than two rate cuts in 2025, that could upset the market. But as we triangulate all of this, we also have to take into account what the updated set of economic projections are going to say for the pace of the economy. I do think the Fed needs to boost its GDP forecast, certainly for 2024, potentially for 2025. What does the updated set of projections show for the unemployment rate? And of course, the most important one, the Fed funds rate. Now, before we get to that, Remember, we won't get to that till Wednesday afternoon. Before we get to that, we are going to get the November retail sales report, and that should show a nice uptick, especially for non-store retail sales, better known as, to you and me, e-commerce or digital shopping. It's really going to be more confirmation. Why do I say that? Because we've already gotten a number of reports that have talked about the strength of e-commerce and digital shopping, especially between Black Friday and Cyber Monday. But we also have to remember that a lot of these retailers were running Black Friday week sales, including Amazon. So I wouldn't be surprised if we see some very favorable numbers, particularly on that non-store sales e-commerce line item. But here's the deal. If the overall November retail sales number misses expectations, that's going to reignite some concerns, not only about consumer spending, but really about the all-important holiday shopping season. I can say that having been around some of the malls in the larger DC area, including the Tysons Galleria Mall and the other Tysons Mall, Tysons Corner, which is a top 5 mall in the US, mall traffic's been kind of thin. So I suspect that even though e-commerce sales will benefit, that we could see some softness in other line items. We'll have to see, but if we do see that, it could be an issue for a lot of brick and mortar retailers. The ones that have been performing well, Walmart, Costco, and the like. Why? Well, food, and because they help consumers really stretch the spending dollars that they do have. So let's see what that report has to say, but we'll also be getting the November housing starts report and industrial production. So when we take those 3 reports coming this week, it's going to make for some interesting updates to GDP models like the one from the Atlanta Fed known as the GDP Now model, which is a rolling GDP forecast. And it currently shows 3.3% GDP for the current quarter. Here's the thing, that was last updated December 9th. So we've got a little over a week's worth of data kind of catch up and see what that revision has to say. But notice the timing. The first update we'll get will be December 17th. In other words, Tuesday, right as the Fed kicks off its December policy meeting. Now, in addition to all of that this week, we are going to have quarterly results from FedEx. We'll be looking at what it says about the pace of the global economy, currency, and the dollar, and of course, any insights for the holiday shopping season. We also have Nike reporting and setting that up. Sorry to say, November retail sales in China missed expectations, but we'll also be interested to see how Nike is battling against Adidas, Hoka, On, and others, and what it has to say, of course, about the dollar as well. We also have quarterly results this week from Micron, so it will give us an update on the outlook for memory demand. But I think, folks, just given where we are for getting ready to shut down 2024 and looking ahead to 2025, they're going to be very interested on their comments about capital spending as well as end market strength, particularly data center, smartphone, and the PC market. And finally, as it relates to smartphones and chips, Qualcomm and ARM are heading to court this week. This is all about ARM saying that Qualcomm breached its contract. Ultimately, my suspicion is that neither one wants to have an enduring battle or wants to give up the revenue that they have given the relationship. So what I suspect is going to happen is we will ultimately see a new licensing agreement hammered out, but it may take a little bit of time. There might be some big headlines this week. Ultimately, when a deal is struck, I think that we'll see the overhang removed from Qualcomm shares, and that will be a positive as it continues to move forward and diversify its revenue stream. So folks, that is the week ahead, and thank you for watching. I will say that given the way the calendar falls over the next 2 weeks with Christmas and New Year's, we're going to say Happy Holidays, Merry Christmas, Happy Hanukkah, Happy New Year, and we'll see you soon.